On May 13th, the market got the kind of inflation report that usually makes risk assets flinch. Producer prices were reported 6% higher than a year ago, and wholesale inflation was much hotter than expected. But instead of a sell-off, the S&P 500 and NASDAQ both closed at new records.
This was not another CPI replay. CPI told investors what consumers were already paying. PPI told them what companies may have to absorb next. Higher producer costs can hit margins first, then pricing, then earnings estimates. That is why this print mattered, even after yesterday's CPI shock.
The normal script says hot inflation should pressure stocks because it makes Fed relief harder. On May 13th, the market refused that script. Investors saw the bad macro number, then kept paying for the companies they believed could still grow through it. The headline tape looked strong. The S&P 500 rose about 0.6%, the NASDAQ climbed about 1.2%, and the Dow slipped about 0.1%. Big tech did most of the work. That is real strength, but it is not the same thing as broad health.
Breadth has been a warning before, but today's version was sharper. Most stocks actually fell on a day when two major indexes set records. That tells you the rally was not everywhere. It was concentrated enough for the index to look great, while plenty of portfolios felt ordinary.
Yesterday's issue was whether hot CPI made cuts harder. Today's issue is tougher. Can the market keep rising even if quick Fed help is not coming? Hot PPI makes the rescue trade less automatic, but the tape showed buyers were not waiting for a rescue.
There was also a real change at the top of the Fed. The Senate confirmed Kevin Warsh as chair in a 54-45 vote, replacing Jerome Powell. That does not tell you the next rate decision by itself, but it changes the backdrop for a market dealing with 6% producer inflation.
The bond market was less impressed than the stock indexes. The 10-year Treasury yield edged up to about 4.47%. That keeps pressure on dividend stocks, real estate, utilities, and any valuation story that needs lower discount rates to work.
The bullish case was not just blind optimism. One market discussion pointed out that the S&P 500 had risen while its price-to-earnings ratio was lower for the year because earnings were doing some of the work. If profits keep rising, buyers can justify staying in longer than macro bears expect.
AI was still part of the cushion, but this is not the old software moat debate from earlier in the week. Alphabet was held up as an example of search and cloud strength, and GPU compute pricing showed up as a market structure watch item. The point is narrower. AI leadership still has buyers, even on bad macro days.
The risk is not that one ugly PPI print automatically breaks the market. The risk is that producer costs start showing up in margins, earnings revisions, or the next consumer inflation readings. If that happens, record prices become harder to defend without help from lower rates. The confirmation is more important than the headline. Watch whether breadth improves, whether tech earnings estimates keep rising, whether the 10-year yield pushes higher, and whether producer inflation leaks into CPI or PCE. If those checks fail, the record index level can hide more stress than it reveals. The takeaway is not that inflation stopped mattering. It is that the market still had enough tech and earnings momentum to look through one more bad inflation print. That is bullish, but it is a narrower kind of bullish. The cushion is holding for now, but it is getting smaller.